Hello, and welcome to Portfolio Matters. In today's podcast, we'll be looking at the outlook for US natural gas production and prices. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Okay, first of all, thank you to our donor, Andrew M., who put me onto this. As you'll be aware, natural gas prices are rising rapidly in the US, and the question is, can that continue? So the conclusion of this presentation is going to be that the shale gas supply shock is coming to an end. US natural gas production has seen a decade of extraordinary growth as US shale drillers develop the techniques to unlock US shale gas and oil supplies from shale rock. But after a decade of extraordinary growth, that growth is slowing. Now, Andrew M. sent me a report from Goering and Rosenzweig. I think I pronounced that correctly, who are saying that based on their analysis of the prospects for the Haynesville and Marcellus shales, that they think those two shales are close to peaking. We will go into that. So the story of the last decade is that US natural gas prices have been very low by historic standards because of the enormous growth in US gas supply from shale. And essentially, supply growth has surpassed demand growth. But I think that is going to change, and that going forwards, demand and supply will be in much closer balance, and therefore, even without the Goering and Rosenzweig forecast of peak shale gas, you can expect a much tighter market going forward and higher natural gas prices. So in summary, I think that next cycle, and I mean after the coming recession, next cycle, you should expect to see natural gas prices closer to historic norms. That is $8 per million BTU and above, compared with the last decade. And that is assuming that the current trends continue. If Goering and Rosenzweig are right, and Haynesville and Marcellus are close to peaking, then you could see a much tighter market and materially higher US gas prices. Bear in mind, European gas prices are multiples of US gas prices. Okay, so an overview. So the green line at the bottom is US gas prices over the last 2 years, whereas the light blue line is European gas prices at the Dutch rebalancing point, TTF, and the dark blue line is Asian spot LNG, and you can see that American gas prices are a fraction of international gas prices. So will that gap begin to close? But in recent weeks, there has been a real surge in US natural gas prices, which are now above $9 per million BTU. And that's been caused in part by reduced hydroelectric power output. So electricity generators are having to burn more natural gas. Now, this is the story of the last decade. So this is US natural gas production. You can see grew very strongly until 1970, when natural gas declined from a peak and then essentially entered a long plateau until the mid-2000s, when suddenly you get an enormous surge in gas from shale and production rises by 70% in 15 years. And coincidentally, over that period, you see a big drop in natural gas prices as gas supply outstrips demand. But now, gas prices are surging and gas in storage is declining. So going forward, are US natural gas prices going to remain at these elevated levels, or are they going to return to their average over the past 5 years? Okay, so going through the US shale gas regions, and what we're looking for here is to determine whether those regions can continue growing at the same pace they've had over the last 15 years, or whether they're showing signs of peaking. So this is a map of the major US shale regions: Appalachia, Anadarko, Bakken, Niobrara, Permian, Eagle Ford, Haynesville. So the Anadarko region, see, this is quite a small region, producing around 7.5 billion cubic feet a day, and it peaked in 2019, 2020, and it seems to be in decline. The Appalachia region is the largest region in the US, producing around 36 billion cubic feet a day. And you see very strong growth between 2012 and 2020. And then growth has really slowed. So between 2012 and 2020, we saw more than a 5-fold increase in gas production. And since then, really not much. In percentage terms, you're talking about 10%. So I think you can say that growth in Appalachia has really slowed. Bakken, quite a small region, plateaued. Eagle Ford, again, small region, flat, down since 2015. So really can't expect much growth there. Haynesville, still growing, although Goering and Rosenzweig are saying that they're expecting Haynesville to peak in the next couple of years. But again, this is not a huge region. It's about half the size of Appalachia, and growth was quite strong between 2017 and 2020 when it doubled, but since then it's up by a quarter. So growth has really slowed in percentage terms. Niobrara, flat. Permian, where Permian gas essentially is a byproduct of oil production, and growth again has slowed markedly in percentage terms, having had an amazing period between 2012 and 2020 when it, well, at least trebled. And if you look at those fields in aggregate, so this is all the shale gas fields, including the ones that are now in decline, such as Fayetteville, then between 2007 and 2020, you had absolutely enormous growth, 10-fold rise in production. And admittedly, this is the period of the pandemic, but really not much growth more recently. So this is the production from traditional conventional gas wells in the US, and they have been in decline since 1970, and there is no sign of that trend reversing. If you look at natural gas production from conventional oil wells, where the gas is a byproduct of oil production, again, in decline. And this is coal bed methane, again, in decline, and these are tiny numbers. So these are the EIA forecasts for US natural gas production. And between 2000 and 2020, you had the best part of a 75% increase in gas production. And going forward, that is set to slow markedly. So in summary, the US is hugely reliant on 3 regions for most of its shale gas. Appalachia, which in June was producing about 36 billion cubic feet a day, Haynesville, which is producing about 15, and the Permian, which is producing about 20. Now, Goering and Rosenzweig are forecasting that production from Appalachia and Haynesville will soon stop growing and thereafter will decline. Now, what is their argument? They have looked at all the drilling locations in those 2 plays, and they're saying that they believe that in Appalachia and Haynesville, you are now approaching the point at which other shale gas regions started to plateau and then decline. And their analogy is with the Barnett and Lafayette shale gas zones, both of which are now in decline, and both of which reached plateau when around 50% of recoverable reserves had been produced, and decline set in when about 60% of their tier 1 sites had been drilled. So this is the Barnett Shale, and the dark line is the percentage of tier 1 drill sites that have been drilled, and the dark green line is production. You see, production started to decline when around 60% had been drilled. And this is Fayetteville, and you see a similar pattern. So in the Marcellus Shale, which is Appalachia, Goering and Rosenzweig are saying that so far around 45% of tier 1 sites have been drilled, with about 1,500 left before 60%. And remember, the decline sets in, according to them, from 60%. And they estimate that 48% of reserves have been produced. So they are expecting stagnation starting now. And bear in mind, Appalachia is the largest shale gas producing region. So stagnation from Appalachia means that total shale gas production is likely to start plateauing. So this is the Marcellus Shale, Appalachia, and you see we're approaching 50%, the point at which production starts to plateau. At 60%, it starts to decline. Okay, so in their analysis of the Haynesville region, they're saying that they expect 50% of reserves to be produced by October 2023. So in summary, they're expecting Appalachia to start plateauing now, Haynesville to start plateauing in a couple of years' time. So returning to our chart of US shale gas production, you can see that Appalachia, the Marcellus, is by far the largest shale gas producing region, and Haynesville is number 3. So if those two go into decline, it's difficult to see continued growth in US shale gas as a whole, particularly as we've seen the other shale regions largely have plateaued or are in decline. The only one which is continuing to grow is the Permian, which is number 2, the second largest producing shale gas region. Okay, so that is the bear case for US shale gas production. Well, what's our view? Well, I agree that the US shale gas supply shock is coming to an end, that growth in supply is slowing and is likely to plateau in the coming years. Demand has caught up with supply due to switching from coal to natural gas for power generation and LNG exports. So LNG exporters can take advantage of very low US gas prices and then export the gas to Europe and the UK and Asia, where gas prices are much higher. But going forwards, I think US natural gas prices are likely to be higher next cycle than they have been over the past 10 years, even without believing the Goering and Rosenzweig thesis. And I'd like to go back to principles and remind you of some relevant economic laws. I put laws in quotation marks because these are economic laws, not physical laws. So first of all, Say's law. A product is no sooner created than it, from that instant, affords a market for other products to the full extent of its own value. In other words, supply creates its own demand. When you provide a useful good, eventually the market will find a way of utilizing that good. Now, it may take time, but it does so. Secondly, Jevons paradox. And so William Stanley Jevons was a British economist who studied coal in the 19th century. And he said this: "It is wholly a confusion of ideas as to suppose that the economical use of fuel is equivalent to a diminished consumption. The very contrary is the truth." So in essence, the more efficient we become at using an energy source, the more we lower its cost, and perversely, the more we use of it. So economy actually increases demand. Now, if you re-examine the chart of US natural gas production, it's grown by 75% in just over a decade. And according to Say's law, eventually industry will find a way of using that resource, but it takes time. And during the past decade, the reason we've had low US natural gas prices is supply has outstripped demand. But now the economy has adapted. In particular, US power generators have switched from coal to natural gas. And if you look at the EIA's graph showing consumption of natural gas by sector, you'll see that actually majority of the increase in demand for natural gas has come from the energy sector, power generation sector. So currently, power generation consumes 37% of US natural gas production. But another marginal consumer of US natural gas supply has been LNG exports. And the US has gone from a net importer of gas to a net exporter really quite quickly. And this is US LNG exports, which are growing very fast and are forecast to rise from 11 billion cubic feet a day currently to 15 billion cubic feet a day by 2026. And if all the proposed LNG liquefaction capacity is built, the US will become the largest LNG exporter in the world. So this table from the EIA shows that US natural gas supplies are around 110 billion cubic feet a day, including around 7 billion imported via pipeline from Canada. And if we think of the EIA's forecast that LNG exports will rise by about 4 billion cubic feet a day in the next 4 years, that really equates to only 4% of total production. That should not really change the balance of supply and demand by very much, unless the market is very tight. So, in conclusion, I think the US shale supply shock is coming to an end. That after a decade in which US shale gas supply rose really quickly and essentially swamped demand, the demand has caught up. And going forward, demand and supply will be in much closer balance. And that means prices will return to their norms of previous decades at least. So if we return to the chart showing US natural gas prices, you see that pre-shale gas prices averaged around $10 per million BTU. And now that demand has caught up with supply, I would expect prices to return towards those norms. And if Goering and Rosenzweig are right in that Appalachia and Haynesville are approaching plateau and will then begin declining, then prices could rise materially above their pre-shale average. However, in the short term, as regular viewers of the weekly will know, we are expecting an economic slowdown, which will be bad for commodity prices of all kinds, including natural gas. And therefore, this is something to look out for the coming cycle. And if you're interested in this, then these are some investment ideas that were suggested by members of our Discord channel. And so I'd like to thank Simon W, JB, Orange Cannon, and Uncool Tom for their suggestions. Uncool Tom also suggests buying the long-dated natural gas future, which is trading substantially below spot. And if my thesis is correct, then long-dated natural gas futures are seriously underpriced. Okay, that's it. Thank you all for watching. Please, can you press like and subscribe to the channel? And thanks once more to our donor, Andrew M. In the meantime, it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.